there is this Indian inclusion into the index, the JPM Bond Index. There will be a steady flow of money, and even otherwise equity flows are very good. But because of the debt flows, do you think it can be managed in the normal scheme of things, or do you think something extraordinary like an OMO sale or MSS or something will be needed?
No, you see, we have multiple instruments at our disposal to deal with situations of excessive inflows. I mean, there are options of OMOs. There is option of the standing deposit facility. We do the VRRR, variable rate reverse repo operations. So we have multiple instruments at our command, and we will use them as time requires. But specifically about the inclusion in the bond indices, you see, it will happen over a period of time. It is going to happen over a period of about 10 months or so. Over a period of 10 months, it will happen. And I would believe that some of the money which was to come during this period has already come in. Even, once the announcement came, money has started coming in. So therefore, part of it has already happened. Whatever remains will come in a very, will come in periodic, monthly basis it will come. So what
1% every month.
So therefore, that is not something which, worries us. That is something which we have managed in the past, and we'll be able to manage it. I don't see any major disruption on that account.
Okay, I'll tell you, one of the things about the way Reserve Bank manages the currency, there are obviously unexpected inflows and outflows, is this terrific stability. In fact, for some months together, it was only moving between 83 and 83.30 for several months, and then of course you allowed it to fall a bit. Doesn't this lead to complacency among importers and exporters? Isn't that a danger that worries you? They don't hedge enough.
Achha, you're talking about hedging.
Yeah.
Now, hedging, so far as ECB...
RBI is hedging on their behalf.
Somebody may think like that. I mean, somebody may think like that. But I don't think it will be like that, because first thing is that so far as the ECBs are concerned, they are fully hedged.
Yeah.
So that component you have to keep out. Then there is whole, automatic or natural hedging. People who sort of who have export income, so they have their inbuilt natural hedging. So far as the overall hedging numbers are concerned, for some time in 23, it looked as if the hedging, the unhedged portions were going up. It did look that way. But from January onwards, from January to March, if you look at the numbers, the unhedged part of forex exposures, the unhedged part has started coming down, and the hedging has gone up. So the businesses and the corporate houses are doing their own assessments, and they are taking a call, and they are doing it, and it is something which we constantly monitor also. Last quarter onwards, sorry, not last quarter, I mean 1st January onwards, for the it has started picking up.
Okay, so you don't worry that RBI keeping it on a tight leash is...
No, we are not keeping it on a tight leash. Believe it. Market perhaps, or some people may think that, we are only keeping it a kind of a range. It is not so.
No, actually, one of the rating agencies even mentioned it, that it is practically a managed...
I mean, there are... yes, I am aware about it. But look, India has changed. The macroeconomic fundamentals of India are today much stronger than it was a few years ago. Macroeconomic fundamentals are very strong. The growth momentum is very strong. International investor confidence is also very strong. JPM Bond Index inclusion also means that, the flows will be there. Our huge forex reserves also gives confidence to the international investors to invest in India, that India is in a position to meet its external payment obligations. So you have to look at the so-called, stability of the Indian rupee in this background. So I would say it is more to do with our overall stable, strong fundamentals than anything else. Reserve Bank, I again would like to stress, we only manage excessive volatility.
Okay. But do you think, given exactly the reasons you say, that there is a very good chance of a rating upgrade?
It should have happened even earlier. I would feel it should have happened earlier, But yes, I think it
Our
should
deficit
follow.
is higher compared to other
Which
countries.
deficit?
Our fiscal deficit is higher compared
higher.
to other countries in the
Yeah.
BBB minus.
But it is on a, the government has announced a consolidation, fiscal consolidation path.
Yeah.
And the interim budget gave a fiscal deficit of 5.1. And next year, 25-26, it's supposed to be 4.5, according to the roadmap which government has given. Things appear to be moving in that direction. So I think a rating upgrade, it should happen.
have happened.
Yes.
Okay.
It should have happened earlier, but it should happen. But I think now internationally also, yes, there are some investors who go by the rating, and the cost of borrowing also depends on rating. I am not saying that the rating doesn't play a role. But I think more than that, the large investors internationally today do their own, do their own analysis and take their own call, whether, how much they want to invest.
Yeah,
and
markets are ahead of rating
markets
agencies.
are ahead,
I mean,
I think you have put it very appropriately. Markets are ahead of rating agencies.
yeah, the companies, corporates tell us when they borrow. Let me come to the unasked part of the monetary policy, the stance. The stance has remained unchanged for a goodish bit. What do you think, and what will make you change it?
You see, the stance has been, we have called it withdrawal of accommodation,
Yes.
and there is a reason for that. Target is 4%. We are nowhere near 4%. We are still around 5%. But the expectation is that it is moderating, and it is indeed moderating.
Yes.
But the pace of moderation is very, very slow. It was 5.1, then I think it became 4.9, then 4.7. So it is moving very slowly. Now, one idiosyncratic development of some monsoon, flooding or some weather-related event can upset things. The vegetable prices can go up. So therefore, and the point is, even today we are still around 5%. So if we want a faster alignment of our inflation with 4% target, the monetary policy should be much tighter.
Okay.
It should be much tighter, it should be much more restrictive. But we have not done it because we do a balancing between growth and inflation. So therefore we have not done it. We have chosen a calibrated path to aligning the inflation with the target. So therefore we are still quite a distance away from 4% target. Given the distance that we have, which is currently 70 basis points, which may go to 80 basis points, given this much of gap, I think it is, it will be too early to talk in terms of change of stance. Okay. Unless you are somewhere close to 4%. You see, unless you are somewhere there, the question of changing of stance, I think, will be very premature. Okay. It is quite possible. Like, the second quarter inflation number is expected to be lower. But then again, it is expected to go up. Annual average, we have said 4.5%. So when we move towards 4%, on a kind of a sustained, durable basis, only at that point we may get a confidence to have a relook. Okay. I'm saying to have a relook, nothing more than that.
Okay. In preparation for this interview and long-awaited interview for me, I read one of those bulletin chapters which speak about the dynamic stochastic model of growth, and they are forecasting 4% inflation in FY26. That model is forecasting. So I was just wondering if you will give me any hint about...
No, I think we have also, MPR has also given a number for 25-26. The Monetary Policy Report has also given a report for next year. So we are still months away from next year. So let's see.
Okay.
Let's see.
All right, fair point, sir. Let me come to some obvious banking issues.
And also let me say with all sincerity, I'm not trying to sort of dodge the reply. Just imagine the kind of uncertainty that we have. So therefore, and we are nowhere near 4%, but yes, we are very optimistic and quite confident that it is moving towards 4%. But it's moving very slowly. So let's see.
Fair point, sir. Fair point. Actually, yeah, tomatoes at 120 rupees, so we have to be careful. It's monsoon. Let me come now to the banking sector questions. The two obvious things that the market is waiting for from you is this project finance provisioning. You have raised it to, you want it raised to 5%, and once the project is completed, even then it is coming only to 2.5%. Standard loans is only 0.4. So you're really asking for a very big provisioning. Is there any chance it will be softened?
You see, what we have given out is a draft circular.
Yes, it's a draft.
In fact, we are now adopting in our regulations, we are adopting a very, very consultative process.
Yes.
And in fact, in the annual report also, if you recollect, or you may have a look, or your viewers may have a look, in the annual report for, last financial year, there's a separate box item, there's a separate annex, where we have listed out all the regulatory measures which we have taken, the number of regulatory measures which followed a consultation with the stakeholders.
Okay.
So we are now actively consulting. There is a consultative approach for making of regulation making. So this is also a part of our consultative approach. What we have put out is a draft circular. We have started receiving comments, and based on the comments that are received, we will examine the comments and then we will come out with a final circular. The purpose of the draft circular is to adopt a consultative approach to get out external inputs and examine them with all seriousness.
See, this is not a discussion paper. This is a draft regulation. It's
circular.
almost ready to
It's
go.
a draft circular.
So the fear of the industry is that you won't tweak it much.
No, it is a draft. We have said it is a draft. So when I say it is a draft, I am not saying that we will not tweak much, or I am not saying we will tweak it so much. It's a draft circular, and our approach is consultative. We take this consultative process very seriously.
Okay. What about expected credit loss? The ECL rules. Obviously, there will be pushback from some banks. But
no, that is already, I think we are working on it. It's on the final stages.
So it is something that will come in this financial year, you think?
Financial year?
Yeah.
Yeah, of course.
It is coming in the financial year. FY25, you want expected credit loss?
I mean, it has already, the comments have all come. They're in the final stages of
No, actually, the project finance rules, higher provisioning, is almost like expected credit loss for that section. That's why I asked whether you will shelve that to a later part.
No, we are also equally concerned about how it will impact the balance sheet of the banks. And also, in some situations, the banks need to, this is a part of our macroprudential approach. The balance sheet of the bank has to remain strong at all times. There cannot be surprises. So all risks, perceived risks, have to be appropriately and adequately provided for. So therefore, this ECL framework, this expected credit loss, or the project finance norms that we have come out, this is only to strengthen the balance sheet of the banks. And we are following a consultative process. We try to understand what is the point of view on the other side, what are the difficulties they have, and then we'll move forward.
The point of view clearly is that they will pass on the cost to the infrastructure company. So infrastructure financing becomes expensive.
Any financing by a bank has to be sustainable.
Okay.
You see,
there is competition in the market.
There is competition, and also, you cannot do a financing. The model of financing should not be should not be subject to any kind of unmanageable, unmitigable risks. Every risk has to be properly assessed, and it has to be provided for. It has to be mitigation measures have to be taken. So therefore, the cost of infrastructure financing also will depend on the perceived risk or the risk assessment. Every bank loan, there is a risk, why do we provide a risk weight? It is based on an assessed risk. Okay. So therefore, infrastructure financing also, effort is to see that the risks are appropriately provided.